Okay, so in case of the discounted cash flow method, what we did first was a discounted cash flow. So we sum up the NOPAT, depreciation and amortization, the investment in working capital, and the capex. After that, to get the growth rate for the next 3 years for the projection, we use the formula, the Harvard formula, which is ROE times 1 minus the payout, and the result was 17.03%. So the DCF growth in 2020 and 2021 in a 17%. And then to get the perpetual D, we consider mature companies such as Coca-Cola, Microsoft, McDonald's, IBM, and then we got the average, which was 5.58%. Also, we made an assumption related with the fact that the economy will be stable. Then to get the terminal value, we use the Shapiro formula. So we use the last DCF value, and then we divide it between the WACC minus the perpetual G. Then we got the flow, and finally the enterprise value, which was the net present value, using the WACC as the rate and the two values of the flow. Then we took from the enterprise value the debt of the company to get the final equity.
Well, according to the discounted cash flow method, the value of Adidas is 111 million euros. We obtained the enterprise value with a WACC equal 9%. So we did the forecast with the formula G equal ROE pay 1 less payout to find the percentage of the expected growth. The result was 17%, and we also got a perpetual growth of 5.58% as a result of an average from companies with a stable economy and mature companies' growth. Also, the intrinsic value of a share refers to a target value of an asset or financial contract. The formula for the intrinsic value is intrinsic value of the share equal to intrinsic value business over the number of outstanding shares. According to Yahoo charts, Adidas has 390 million of shares outstanding. So with this information, we obtained that the intrinsic value of the share is 2,086 euros.
So now regarding the multiple valuation methods, we have two types of valuation methods with multiples: enterprise value-based multiples and equity-based multiples. So for the enterprise value ones, we have that EV to EBIT multiple is 22 times, and to sales is 3 times, and 17 times free cash flow. And if you consider the equity-based ones, which are the P ratio first of 27 times the earnings per share, you could think that those multiples are really high. But if you consider that the company has had really high growth on sales, on their stock share price, and their research and development, and also they did acquisitions and mergers, this company has a really interesting level of valuation. Now I'm going to talk regarding their dividend yield, which is 1.42, which of course it would be desirable to have a higher dividend yield, but it's actually good because first of all, it's positive, and also it's more than 1%, which means that just with dividends, an investor will have more than 1% of profitability in a year. So in the next slide, I'm going to explain some investor-related analysis, which is good to have because the past multiples that I've explained seems really high, but now we are going to understand that these ratios and multiples are really attractive for an investor. So if we consider that in the past 10 years, Adidas stock price has is more than 5 times their share price in 2010, and they have right now a P ratio and dividend yield evolution like presented in this graph, which dividend yield is really increasing in the past 4 years, and their P ratio is actually decreasing. Considering this growth, it's really, really, really attractive for investors. And just for you to know and reinforce this explanation, I have presented here the Nike ratios, which P is 79 times, which is really high, and their dividend yield is less than 1%. So if we consider that Adidas growth on their share price and in their sales and their projections are really high and really attractive, this company has still room to grow, and it's really attractive for investors and for existing shareholders.
Well, now we're going to analyze the valuation answers. First of all, using the discount free cash flow method for Adidas, we have that the enterprise value of the company is 100,000 million euros. Due to the value is above the cost of the investment, that in this case is the WACC, we can say that for an investor, the opportunity to invest and have better results is higher. Then we have the multiple method. We use like 3 types. First of all, is that enterprise value divided by the bid. With the enterprise value divided by the bid multiple method, Adidas for 59,000 million euros and trades 22 times its EBIT, therefore could be overvalued. With 22 years of benefit, the company will already get everything the company is worth. Then we have the enterprise value divided by sales. The ratios vary between 1 and 3. The lower the ratio, the cheaper the company is. In this case, we have a ratio of 3. This means that the firm value is 3 times its sales, so it's expensive and may overvalue because you need to sell 3 times more what you sell now to achieve the total worth of the company. And at least we have the enterprise value divided by the free cash flow. We have a ratio of 17. That means that the company worth is 17 times its free cash flow. Sometimes it's important that a company with its high ratio means that they can pay back the cost of its acquisitions or generate cash to reinvest in its business fast. And at least we have like the market capitalization method. We have the enterprise value by market capitalization of 53,000 million euros. This means that Adidas is classified as a large cap company. These types of companies have usually been around for a long time, and they are major players in well-established industries. Not always generate the huge returns, but the safest one. PE ratio. The Adidas PE ratio is 27. This means that one investor will have to pay 27 euros for one current earning. Sometimes a firm with this high ratio could seem like that a stock price is high relative to earnings and possibly overvalued. Dividend yield. Adidas has a dividend yield of 1.32%. That means that an investor could have 1.42% of return per year. For being a large company, the dividend yield is not so high, and investors are always looking for high returns, but it's not always the most important. Some investors look for companies that have a dividend yield raising and with enough financial strength to continue paying dividends. Is a company sustainable? Adidas in that through sport, they have the power to change life, but the sport needs a space to exist. These spaces are increasingly endangered due to man-made issues, including human rights violation, pollution, growing energy consumption, and waste. That's why Adidas taking account these topics in its business strategy, like environment, sustainable materials and process, and approach to human rights and working conditions. For example, in environment, they have like a reduction in 52% in all the carbon emissions versus 2015. In electricity, they have increased green electricity in 18%. In water, they have increased 37% the savings water between 2018 and 2019. In chemicals management, they have a whole program to manage the chemicals that they use in the process of the production. And in transportation, they track how much like the transport that they use could affect the environment, and that's why they use just like, for example, sea of freight and not air freight. Also, they use just sustainable cotton. About the recycled polyester, 50% of all the products in 2019 were made by recycled polyester. Also, they produce 11 millions of shoes made by recycled plastic. And well, they are always looking for some circular business solutions. For example, they have this Future Craft Loop that is a fair shoe made by just one material, totally recycled, and campaigns like Run for the Ocean. About the human rights and working conditions, Adidas is FIFA's independent advisory board on human rights. Adidas drives investigation of forced labor in the cotton supply chain in Xinjiang in northwest China. It's a contributor to UNICEF. And to evaluate the working conditions, they have these factories evaluations.
Is there any potential merchant acquisition for Adidas? 15 years ago, Adidas made one of the biggest purchase of its history. They bought Reebok, but during all this period, they didn't have the sales level that Adidas wanted or was expecting. So they have decided to sell again this company. But this bad experience is not the only point to consider. Because Adidas financial situation, it's okay. They are not over indebted. They are still adding value. They are good. Its financial situation is good, so they can afford a new merchant acquisition. So they have two options: an horizontal or vertical integration. The first one option is Puma, because with this company, Adidas has a related history. Both creators are brothers, and both were born in Germany. Both brands were born in Germany. And Puma lately has changed its marketing strategy. Now it's more aggressive. They have signed deals with Lewis Hamilton, Neymar Jr., and they have increased its market share. So this company is good for a merchant acquisition. In the case of a vertical integration, they have to consider that one of the most important activities in this industry is the research and development. Many years ago, Adidas created a polymer called Boost with BASF, a German chemical company. And this is very important because this material is a big differentiator with the competitors. So Adidas should buy or integrate with a laboratory so they can keep testing, designing, developing new materials, new process. Nowadays, it's very important to recycle materials, so they would need, again, a laboratory, and they could also keep developing comfort materials, and if they have a laboratory, they would be able to create more patents, and they wouldn't have to share revenue with any other partner. So a laboratory would be okay for an acquisition.
Adidas use financial derivative instruments such as currency options, forward exchange contracts, share price options, as well as forward share transactions. and currency swaps to avoid risk in currency exchange and share prices. The company has treasury policies that prevent the company from transacting with derivative financial instruments for commercial transactions. At the time the company enters into a derivatives contract, derivatives are designated as to hedge a planned transaction or hedge an investment abroad. In addition, the fair value of currency options where there are forward exchange contracts and forward share transactions. They are determined on the basis of market conditions on the date of the report.
So, conclusions and recommendations. The market capitalization of the company is very high, which represents acquisition, sales growth, and market presence all over the world. But nevertheless, the company has still room to grow since their R&D investments are high and their PE ratio is still attractive when compared to the same industry competitors like Nike. In that sense, the company's final financial situation and operational projections are attractive for existing shareholders and possible investors. Adidas' investment in R&D are making the company more competitive and sustainable. This helps Adidas to create value for its customers, and at the same time, it makes the company more attractive for the investors. So, recommendations. Adidas' repurchase of shares strategy seems to be working well when creating value for shareholders taking advantage of its healthy financial position. In order to have cheap financial leverage possibilities in the future, they should keep taking advantage of external debt opportunities and plan to do a share emission in case they need liquidity in the future. The company must focus the R&D on creating more eco-friendly products, optimize its process, and reduce waste. This effort to reduce environmental impact will be rewarded with more customers, good marketing, increasing sales, and also access to new kinds of financing like green bonds.